Hello, Alexander here for Intermediate Accounting, Chapter 2, Example. So what we have here is for practice 2.1, journalizing. The scenario is this journal entries are necessary to record the following transactions. This is about selling on account. So sold merchandise costing $14,000 for $22,000. Of the $22,000, $4,000 was received in cash, and the remainder was on account. So of the $22,000, as you can see, $4,000 we got as cash, so we debit cash for $4,000. That leaves $18,000 as accounts receivable to still be claimed, because 4,000 minus 22,000 is 18. And then of course we have sales of 22,000 that we still have to credit. So we're crediting for the whole amount of 22. Of course, assume a perpetual inventory system, meaning that the inventory is reduced at the same time. So perpetual. Cost of goods sold. Remember, this is inventory. So as we sell merchandise, we don't just record the sale, we record the cost that we incurred, that we had to pay or put into it. So we debit cost of goods sold for $14,000, and we credit inventory for $14,000. So because it cost us $14,000 to make or to buy ourselves, and then it reduces our inventory once we sell it for $14,000. So for the next practice 2-6 posting, this was a great one because it just showed how to use a T account. That's why I included it. The beginning balance in the cash account was $10,000. So beginning. During the month, the following 4 journal entries were recorded. So for A, we had a cash sale. We received $2,775 and we credited sales. So we're just dealing with the cash account. So we debit cash on the left, debit on the left. $2,775 increases us to $12,775. Next, B. Accounts payable went up. Accounts payable went down $1,500. Cash went down $1,500. So we paid our accounts payable. So our cash goes down by $1,500, which lowers our cash, which leaves us with $11,275. Next, utilities expense went up $6,200. Our cash went down $6,200. So that means I credit cash for $6,200 on the left, lowers us to $5,075. Next, D. Sold land. So we sold it and we had a gain. Our cash went up $4,100, which left us with $9,175. Pretty good, huh? So that's a T account, and that's exactly how you use a T account. For cash, debits increase it, credits decrease it, and you just kind of like to mark what's going on, like how it relates to the transaction, so I don't get confused and I space it. And then I use lines to show when I'm either subtracting or adding. Okay, next up, practice 2-14, adjusting entries. This is, let's give you the scenario. Make the adjusting journal entry necessary at the end of the period in the following situation. On August 1st, the company borrowed $10,000, made under a 1-year loan agreement. The annual interest is 8% as of the end of the year. No entry has been made to record the accrued interest on the loan. So at the end of the year, that's 5 months has passed, because August, September, October, November, December. So 5 months have gone by since we had the loan. It's the end of the year. We're doing the financial statements. We have to adjust first. So we got to catch this interest up so that it's on the income statement. So the equation is 10,000 times 8%. That's for a full year's worth of interest, but we're only doing 5 months. So we times it by 5/12. 5 divided by 12. That gives us $333.33 repeating infinitely. As a banker, you might actually round that up to 34 cents to make a little bit more money, because banks always want it in their favor. And you see the 5/12, it's 5 months out of 12. That's how you do interest when it's not a full year. And so, of course, we debit interest expense for $333.33, and then we credit interest payable for $33.33 because we haven't paid it. We're just realizing we owe that. All right. Last but not least, practice 2-17, closing entries. Make the closing entries necessary to close the following accounts. So it gave us a bunch of accounts. One of them was cost of goods sold, accounts payable, paid in capital, cash, sales, dividends, retained earnings, and inventory. Of course, one thing this book is notorious for, thank you Stice boys, is it'll give you stuff to throw you off. You don't close accounts payable. You don't close paid in capital. You don't close retained earnings or inventory. So you might have closed it, but you don't do that. But in this book, it's a tough book. It's going to try to throw you for a loop many, many times. And it's already starting up on chapter 2. So all we're going to close is sales, cost of goods sold, and dividends. That's it. That's all that are temporary. So sales, remember, no income summary anymore. That was baby accounting. We're now on the grown-up accounting. So sales, we debit for $11,000. Retained earnings, $11,000 is credited because increasing it. Next, retained earnings is debited for $7,000. And we credit cost of goods sold for $7,000 to zero it out. It's gone. It's back to zero. It's ready for next month, next year, next quarter. And last is retained earnings is debited. Dividends credited for $900. We zero out the dividends account. Dividends is treated like owner's draw. That's exactly how it's treated. So, bada bing, bada boom. That's how you do it. So, I hoped that I was almost going to do a big problem. And I was looking at it and I was like, well, the big problem only covers didn't cover a whole lot. It was just adjusting entries. And I thought, let me hit you with a flavor, a sampler, because I feel as though you get more out of this. You get a more broad range than just one big problem that has one certain aspect to it, which I can always do later, but this is a great to show you as a refresher what's in chapter 2. And so thank you so much. Please like, comment, subscribe, all that jazz. And thank you, and I'll see you next time.